going. As promised, we have the management of Narayana Health with us, and the company reported numbers for the quarter gone by, where revenues have risen by a solid 78% on a year-on-year basis. Sandhya J, a Group CFO at Narayana Health, is now joining us. Thank you for taking your time out and joining us. And it was indeed a strong quarter with revenues rising 78% YOY. But margins, meanwhile, have narrowed. If you can take us through what led to this kind of divergence and what is the outlook looking like for the next 2 quarters?
Good morning. Thank you for having me here. If you see the story of our business, it's in 3 parts, as you're aware. There is the India business, there is the Cayman business, and the UK business. The India business had grown 17% in terms of revenue and expanded margin by more than 400 bips. The Cayman business had more or less held margins. The hospital significantly recovering from last year because we've been able to catch up on the new capacity and it's fully operational and back to earlier levels in terms of margins. But we are investing in the insurance business in Cayman, which is still making losses. And because of that, Cayman has come in kind of flat to last year. The dilution has largely come from UK. It's a new book of business we have acquired. It comes in with a lower margin profile between 8 to 10%. This quarter had been even more lower because of the weather-related disruptions that the entire industry has seen in the UK. But that has caused the dilution from a margin point of view. So overall, I think it's a very positive story, both on revenue as well as margins, because the core business has significantly expanded its margin potential.
Okay, understood. So that's your outlook on margins and the explanation behind how they've shaped up. But hi, good morning. Also help us understand how much of that organic growth that we've been seeing, or rather how much of the growth that we've seen is organic in the India business versus the UK acquisition now being a part of the base. Can you give us a split?
Sure. So if you see the India number, the growth, about 17% growth has come. We've not added any capacity in India. So which means the entire growth has come organically without capacity increase. The component of UK in that about 65 million pounds is the Q1 revenue, which is included in that number. If you see from a year-on-year growth point of view, the entire number is incremental. Quarter-on-quarter, UK slightly declined. So when you see a quarter-on-quarter growth, despite the UK decline, our number has been what it has been. As far as the EBITDA is concerned, in that EBITDA, we've reported about 5.7 million GBP is included as our UK EBITDA. So that's the EBITDA contribution of UK to the business.
Meanwhile, Sandhya, as far as India hospital margins are concerned, they continue to remain strong at that 25% mark. And last quarter, you did tell us that it was driven by robotics, transplants and case mix upshift, and that you're very confident that gains are sustainable. If you can take us through what the India business looks like, especially from a margin standpoint.
So a lot of the gains have come because, like you said, we have been able to do higher value procedures. Also, the revenue and volume growth. So if you see, we have reported very healthy volume growths in Q1. That volume growth has come without any capacity addition, which means we've held the cost flat and increased the revenue, and that has given the leverage benefit. So therefore, we do believe that this number is sustainable.
Okay, so we're going to be watching out for that and looking forward to that. But Sandhya, also tell us on the Capex front, you had confirmed a ramp towards roughly 1,000 crore a year in FY28, FY29. But if I have to take a look at your FY26 Greenfield Capex, that actually undershot your plan significantly. I understand there was election-related, challenges, labor shortages, permission delays. But is the pace now fully normalized, and do you still see FY28 as achievable, as an achievable timeline for your key projects like the Rajarhat project?
So whatever we've given in the latest update, which is FY28 and FY29, we have about a 6 months kind of delay in some of the projects, not on all of them, but some of them where we had the election and labor related disruptions. So it's not a very big extension, and we do believe that what we've reported out is achievable.
Okay, and Sandhya, let's also talk about your Bangalore market because that continues to be your strongest growth market, and the segment itself has reported 20% growth YOY. You had earlier attributed Bangalore's high realization to sheer procedural complexity and volume. Is there any ceiling to how much more complexity led growth Bangalore can deliver over the next few quarters? Is there more headroom for growth?
There is headroom for growth both in volumes and in complexity. For example, right now we are performing the largest number of cardiac robotic surgeries in the country from our heart hospital in Bangalore. We are doing the largest number of pediatric bone marrow transplant in the country, again across, but significantly led from our Bangalore facility. We also are doing CAR T in one of the few hospital networks in the country who have the capability to deliver CAR T therapy. So there is definitely more scope to keep being able to do higher value procedures, and there is also scope to increase the throughput through these hospitals because we are continuously investing in throughput enhancement. There is headspace in bringing down the ALOS even more. Currently, our ALOS is at 4.3. While we are doing higher order complex procedures which come at higher ALOS, and that's why it's so high. But we have the scope to bring down the ALOS in some of our regular procedures. So that can give us more capacity. So yes, there is headspace in Bangalore.
Understood. Very quickly, Sandhya, just trying to squeeze in one last question. Last quarter you said that Cayman insurance losses were running at a loss ratio of around 110 to 112%. This quarter in the commentary you've said that losses have likely bottomed out. What's the outlook over here? What has changed in this one quarter that's making you more confident on the Cayman insurance segment of the business?
So one is that our renewals are coming up with a price increase. So we have a cycle of renewals which we have taken in June, and the next cycle we will take in January. So these renewals we have taken with a price increase based on the loss ratios. Secondly, also we have slowed down a little bit on the in terms of how we are underwriting, and therefore we are picking up businesses which are coming in at a acceptable loss ratio now that we have a better understanding of the business mix. So both of them put together, I think we are able to be with more confident that we'll be able to bring down the loss ratios for Cayman. They're not fully reflecting in the June numbers because they've just kicked in, but you will be able to see them in the upcoming quarters.
Looking forward to that, and we'll be watching out very closely for the other metrics and the outlook that you've shared with us as well. Sandhya, on that note, wonderful as always to be chatting with you. Thank you so much for your time today.
Thank you.
On that note, viewers, we're completely timed out on this edition of Midcap Masala from Rashesh, me and the team that put this show together. Thank you so much for tuning in, but keep watching ET Now because Buy Now, Sell Now takes all the action ahead.